Hello everybody, I hope all of you are doing really well. My name is Siddhant Mehta and welcome you all to Raftaar batch. Today we are going to revise chapter number 4, that is Valuation, Documentation and Report. In this chapter there are three major topics. The very first one is Valuation Documentation. Here we will understand the objectives and time period of documentation. The second one is Management Representation Letter. Here we will understand the meaning and objectives of MRL. The third one is Valuation Report. Here we will understand the meaning, types and structure of valuation report. And at the end, there are few practical case studies which are given in module. We will have a quick overview of it. Let's first understand what is valuation documentation. There is a specific standard for it. That is ICAI Valuation Standard 202 about reporting and documentation. That is ICAI Valuation Standard 202. This standard says that documenting the work is valuer's responsibility. He has to document all the valuation procedures he has performed, all the relevant evidence he has obtained, and all the conclusions which he has reached. There are two objectives of documentation. The first one is to have a sufficient and appropriate record. Here we all know sufficient means quantity and appropriate means quality. It means that the valuer must have sufficient quantity of documents with him which is from credible sources, that is appropriate, which will help valuer to derive conclusions. Hence this is the first objective. The second objective is all these documents will be work as an evidence to say that valuer has done this valuation based upon ICAI standards and legal requirements. Hence, these are the two objectives of documentation. The first one is to have a sufficient and appropriate record, and second is evidence that the valuation has followed ICAI valuation standards and legal requirements. Now let's understand the time period for documentation. There are two time periods which has been given to you in module. The first one, if you are a registered valuer doing valuation based upon Companies Act, then Companies Rule will be applicable to you. And as per Companies Rule, you have to maintain document for 3 years minimum or longer if contractually required. That means if your contract specify that you have to maintain a documents for 5 years, then you have to maintain the documents for 5 years, but you can't go below 3 years. 3 years is minimum. If you're doing valuation as per ICAI valuation standards, then for you have to maintain a document for 8 years minimum from valuation report date. This is important and there will be a definite question on this time period. Just cross check whether they are asking about companies rules or whether they are asking about ICAI valuation standard. As per companies rules, 3 years minimum or longer if contractually required, and as per ICAI valuation standards, 8 years minimum from valuation reporting date. You can maintain this document either in physical form or in electronic form, and all these documents will be valuer's responsibility, valuer's property and responsibility. Then there are some examples which are given about the documents which valuer has to keep with him. Let's understand these examples in the form of diagram where I have bifurcated the documents based upon the valuation process, where the first step is preliminary requirement. Here the client and valuer will discuss the scope of work. Based upon that, valuer will submit the proposal to the client. Based upon this scope of work, this will be the fee structure. Once this gets approved, they will sign an engagement letter and non-disclosure agreement. Here in engagement letter, that is appointment letter, valuer will be officially appointed for the valuation assignment. The second step is understanding client. Here valuer will understand the business of the client. He will understand the business model. For that, he can also take historical financial statements of the company, and he can apply financial and ratio analysis in it. From that, he will understand the company's position in the market, how the company is performing in the past years. He can also do industry research and all the websites which he is referring to understand the industry, to understand the growth in the industry. All that website sources must be documented. If you are referring to any government website, the source of that website must be documented in your documentation. Then the next step is forecasting. Here all the forecast will be given by the management, that is income statement, balance sheet and cash flow. You have to document this. Then the fourth step is your valuation. Whatever assumptions which you have considered in valuation, you have to document it. Then the second is your calculation of WACC and cost of equity or cost of debt. Here you have to document which model you have considered, whether you are calculating cost of equity based upon dividend model or you are calculating it based upon CAPM model. And as we all know, the formula for CAPM is risk-free plus RM minus RF into beta. So from where you have considered this risk-free rate, you have referred to the government website. Okay, give me the source of that website and document it. If you have, if for market return you have referred to BSE or NSE website, then document the source of that website. For beta, you have done any specific calculation based upon the formula which which we have covered in chapter number 3, that is covariance upon variance. You have to present the working of this formula and have to document this in your documentation. How you have performed this working, how you have considered the stock return, how you have considered the market return, all these documents must be documented. And then the very last is valuation model, that is your Excel working in which you have prepared your valuation. You also have to document that model. Then the last step is your final value, management representation letter and signed final report. You have to document your final report. You have to document what all management representation letter which you have considered. All these things must be very well documented. These are the few examples of documents which you have to document. Then the last one, then the second topic is, management representation letter. Here we all know management representation letter means a written statement which is provided by the management which confirms certain facts about the company. Here valuer has to acknowledge all the written representation which has presented by the management and also has to rely on it. But this MRL doesn't means that valuation will not assess the information. He has to assess the information with due care. Here the important thing is written representation cannot include valuation model. Management will not tell us which approach we have to follow, which method we have to follow to do the valuation. The approach and method will be decided by the valuer. This is the important thing. Let's understand the objectives of management representation letter. It is important and there will be the definite question on this objective of management representation letter. There are 3 objectives of MRL. The first one is to obtain a representation letter. That means management has to give MRL regarding their confirmation that they have submitted all the necessary facts. They have provided all the necessary facts to the valuer regarding this valuation assignment. So the first objective of MRL is to obtain a representation from the management that they have given all the facts, they have submitted all the details which are there with them about this valuation assignment. The second one is to support other data. If any evidence has been found in valuation assignment, the valuer will take MRL from the management to confirm this evidence. This is second objective, to support other data. And the third one is to respond appropriately. If management is not providing the representation letter, then valuer has to respond appropriately. That means valuer will decide whether he has to continue working in this assignment or he has to withdraw from this assignment. These are the 3 objectives of MRL. First one is to obtain a representation from the management that they have given all the facts. Second one is to support other data or other evidences which has been obtained in valuation assignment. And the third one is to respond appropriately if management is not providing MRL. Let's understand few examples for which we take MRL from the management. The first one is to understand the business, understand the background and the business operations. For that we can take MRL. Second is to confirm the valuation date on which valuation will be performed. Third is the financial statement for the forecasted period. Management has to give MRL and has to say that they have prepared this forecast, they have reasonably projected these forecasts based upon the historical trends of the company. Then if there is any M&A transaction, then what was the purchase consideration of that transaction, we will confirm it in MRL by management. Then the data which they had provided is appropriate and management has disclosed all material facts. These are a few examples for which you can take MRL from management. Then your last topic is valuation report. Valuation report is a document which is created by a registered valuer with the intention of determining the fair market value of the asset which is being valued on registered reporting date. So here the scope and the purpose of this report will be mutually agreed between registered valuer and intended users. There are 2 constants about information in valuation report. The very first one is cost benefit balance. I will explain it to you with the help of one example. Here the valuer is doing one valuation assignment with very advanced valuation techniques which require more time, more efforts and more cost. But he is doing this valuation to value a startup who is raising a small amount. So it is just like you are incurring 1000 rupees as a cost just to have 10 rupees of the benefit. But in valuation, valuer has to see that the benefit which client is going to get from this information should always be more than the cost which he is incurring for providing this information. He can provide the same information about the startup with the help of DCF method or market approach. Hence, valuer has to assess that the benefit should be more than the cost. This is the cost benefit balance. This is the first constant. The second one is equilibrium between qualitative attributes. That means in valuation, as we know, is about numbers, that is quantitative data, but valuer also has to assess the qualitative data of the company. If there is one company which is in losses but has a very strong brand reputation in the market, has a strong customer loyalty, then in valuation I have to assess both these factors. If I do the valuation just based upon this quantitative data, then it will be inaccurate. But if I did the valuation just only on this qualitative data, then it will be illogical or unreliable. Hence, in valuation, you have to consider that the information which you are considering is about quantitative data and also about qualitative data. There must be equilibrium in it. This is your second constant. Let's understand the types of valuation report. Here there are two types of valuation report. The first one is summary report and another one is a detailed report. Here, as the name suggests, summary report is a limited analysis and the detailed report has detailed analysis with extensive documentation. This is the only information which is provided in module, but just for your understanding, summary report is used by the stakeholders for a quick decision making, and detailed report is given to the investors who wants to invest in a company. It is also given to the regulators. So here, summary report, in summary report you will have only few things like valuation assumption, valuation methods which you have considered, and based upon these assumptions and method I have derived this value. Only these information. But in detailed report there will be a financial statements, ratio analysis, sensitivity analysis, all the analysis which you have conducted will be mentioned in detailed report. Now let's understand the structure of valuation report. The very first thing will be terms of reference, that is detail of the appointment of the valuer for this valuation assignment. It will be mentioned first in terms of reference. The second one is background. Here the valuer has to give information about the company or asset which will help a reader to understand this valuation assignment. You can provide information about the shareholding pattern of the company or the capital structure of the company or any key financial matrix which is there in financial statements of the company. But you have to provide this information which will help reader to understand this valuation assignment. Then the third one is purpose of the valuation. For what purpose you are doing this valuation? Are you doing this valuation for a regulatory purpose? Mention it here. Are you doing this just for internal purpose? Then mention it here. Then there is the identity of the valuer. You have to give details of the valuer and the registered membership number, and also if there is any other experts who has been involved, give details of that experts and their membership number. Then if these valuer and the other experts have some interest or conflict with the company, you have to mention it here. If there is nothing such interest or conflict, then you have to give a declaration that there is no interest or conflict with the company. Then the normal thing, the date of appointment, report and valuation will come here. After that, the source of the information. Like I said earlier, if you are referring to any websites, if you have referred to any websites to understand the data like BSC or NSE to understand the market return, if you have referred to any government websites to understand the industry growth, then you give all the information of the sources of these websites in here. That is sources of information. Then the 8 will be procedures which you have adopted in carrying out the valuation and valuation methodology. Which approach you have considered for valuing the company, why you have considered this approach, in that approach which method you have considered, why you have considered this method, what all assumptions which you have considered for valuing this company or this asset, you have to mention it here. Then in valuation, if there are any major factors which are changing the valuation, which are affecting the valuation, then you have to mention it here, that the major factors which are influencing the valuation. And at the end, the conclusion, what is your final value of your assignment, and then the caveats, limitation and disclaimer. This is the most important part. Here the valuer will mention that I have performed this valuation based upon the projected financial statements which are given by the management. I have not done the audit of these financial statements. I have relied on these financial statements. All such caveats, all such limitations will be provided here at the end. This is your structure of valuation report. Now let's understand a few practical case studies which are given in module. The very first one is about Mango Limited. The company is in tech sector. Here the valuer wants to value this company, but issue here is there is volatility in the market. Hence, valuer has to predict where the market is going to go in upcoming months, and based upon that he has to present the valuation. But it is very difficult thing, right? Hence, he provided the valuation based upon scenario analysis. He provided three scenarios for the company. In a best case scenario, what will be the situation of a company, and based upon that what will be the value of a company. In a worst case scenario, what will be the situation of a company, and based upon that what will be the value of a company. And in a base case scenario, that means if same thing continues, what will be the situation of a company, and based upon that what will be the value of a company. He documented all the assumptions which he has considered in these three different scenarios, which make the report very transparent one with the help of scenario analysis, and it boosts the stakeholder confidence because now they understand how this market volatility will affect the company and what will be the situation of a company in three different scenarios. This is your first practical case studies about Mango Limited. The second practical case study is about ABC Properties. The company is in real estate sector. Here the valuer wants to value this company, but issue here is there is economic downturn. Hence, to address this issue, what valuer did is he documented all the economic uncertainties which will affect the company and which will affect the industry. He considered such economic uncertainties. He also considered what will be the value of a company after such economic uncertainties and provided the valuation report. So here he provided a well documented report providing transparent picture and had also given insights about the economic uncertainties in the market. This is your second practical case study about ABC Properties. The third one is about RD Pharmaceuticals. The company is in pharma sector. Here the issue with this company is there are a lot of legal cases pending with the companies which can affect the future cash flows. Hence, to address this situation, what valuer did is he sit with legal expert. He understand what will be the future cash liability of a company, and then he documented all the legal considerations. He considered the effect of such future cash liability in the company's valuation and then presented the valuation report. So this report helped the company to re-strategize their strategy, and based upon that they are making their decisions now. Hence, a risk-aware valuation reported supported informed decision making in the company, and also based upon this they frame their risk management strategies. Hence, these are the three practical case studies which are given to you in your module, and this is your end of your chapter. If you're loving this content, don't forget to comment and don't forget to subscribe, because your one click is enough motivation for me to keep going. Okay, tada, bye bye, see you in the next lecture.